Every now and then, you get an earnings report that just makes you scratch your head. That's exactly what happened with Nomura Holdings. On January 30th, they dropped their third quarter numbers, and frankly, it presented a real puzzle for the market. So today, we're going to unpack what went down and, more importantly, why the stock reacted the way it did. And here it is, the core of the confusion. On one hand, Nomura absolutely crushed it on revenue. I mean, look at that, almost 20% higher than what analysts were expecting. But on the other hand, their earnings per share, a big miss, almost a 19% miss to the downside. You just don't see a disconnect that wide very often, and when you do, Wall Street definitely notices. And notice they did. The market's reaction was pretty brutal. The stock dropped over 4.5% that day. So what gives? Why would investors hammer a stock that just posted such a massive beat on the top line? That's the big question we're here to figure out. Okay, so here's how we're going to tackle this. We'll quickly go over the headline numbers, then really dig into this battle between their strong core business and the stuff that dragged the final numbers down. We'll hear what management had to say, touch on the tough questions analysts were asking, and then we'll wrap it all up with our final verdict. Right, let's jump in. To really get why the market was so spooked, you have to peel back the onion a little bit. We need to look past those big, flashy headline numbers and see what's actually moving under the surface. Now, management came out swinging with a pretty powerful message. The CEO himself said, look, our main business is absolutely on fire. Pre-tax income from their 4 core divisions, think wealth management, investment management, and their trading desks, was the best it's been in almost 2 decades. That's a huge statement. And this slide really tells the whole story in numbers. It's like a tale of 2 companies. You can see the core businesses brought in almost 143 billion yen in profit, up a healthy 8% from the last quarter. But then there's that other segment. It posted such a big loss that it actually dragged the entire company's profit down by 1%. The core business was pushing the car forward, but something else had the emergency brake on. So what was hiding in that other segment? Well, it really boils down to 2 main things that just weighed down those fantastic core results. First, some one-time costs from a big acquisition, and second, some wild swings from their crypto business. Let's talk about that acquisition first. This is all part of Nomura's long-term plan. They're trying to build a global asset management powerhouse, and they just bought a piece of Macquarie's business to do it. Now, that's great for the future, but in the here and now, well, it costs a lot of money to integrate 2 big companies, and those costs hit the bottom line hard this quarter. All right, so that's the problem, but what was management's story? Unsurprisingly, they spent most of the earnings call trying to get investors to look past all this short-term noise and focus on their long-term vision. And this right here was their Exhibit A, return on equity, or ROE. It's a key measure of how profitable a company is. They hit 10.3%, which is not only good, it's above their own target. And get this, it's the 7th quarter in a row they've done it. They're basically saying, see? The underlying machine is running great. And it all feeds into this broader game plan. Step 1, keep that high ROE going. Step 2, get that Macquarie deal fully integrated and working for them. Step 3, take advantage of this huge trend in Japan where people are finally moving their money from savings accounts into the stock market. And step 4, give some of that cash back to shareholders with a big new buyback plan. And just to hammer home how strong that core business was, the highlights were just wow. Record revenue in wealth management, assets under management in their investment arm hit an all-time high, and the trading and banking division, yep, record revenue there too. Across the board, things were humming. But, even with all those records, investors still had some serious questions, and you could really feel the tension during the Q&A session. This is where we get a peek into what the market is really worried about. First up was the elephant in the room for pretty much any financial firm in Japan. For the first time in forever, interest rates are starting to rise. So analysts basically asked, what's this going to do to your business? Is it going to kill your deal flow? Management played it pretty cool. They admitted things are a bit choppy, but they insisted that, so far, they've seen only a limited impact. Their message was basically, we're watching it, but we think we can handle it. All right, question number 2. This one was a lot more personal. It went right back to one of the things that dragged down their earnings. Analysts wanted to know, what are you going to do about this super volatile crypto business you've got? And on this one, they were very direct. They basically said, message received. While they still believe in the future of digital assets, they've already tightened the reins on risk to make sure these kinds of wild swings don't keep hurting their quarterly results. It was a clear lesson learned moment. So let's put this all together. We've got incredible core strength, but also these messy one-off issues and some investor anxiety. So where does that leave us? What's our verdict as we head toward the next earnings call? This really is the million-dollar question, isn't it? Did the market have it right by punishing the stock for these temporary problems? Or did it totally miss the bigger picture, the fact that the main engine of the company is stronger than it's been in nearly 2 decades? Here's our take. We think both sides kind of have a point. We're predicting a modest recovery in earnings next quarter, simply because that core business is so strong. But, and this is a big but, those integration costs aren't going away overnight. So for the stock price, we see it being range-bound. The market is going to want to see a clean quarter, no excuses, no surprises, before it's willing to give the stock credit for its underlying strength. And all of that brings us to our final rating. Market perform. The fundamentals here are solid, no doubt about it. But these short-term headaches from the acquisition, plus the need to prove they can tame that crypto business, will probably keep the stock trading right in line with the rest of the market for the time being. This is not financial advice.